Welcome to Breaking News to Trading Moves. Today we have a pretty clear mission. We're going to examine the resource allocation and, the market positioning all around this ongoing AI data center build-out. We've looked at recent analyst updates, a lot of market segmentation data, and we're going to try to understand exactly where the capital is flowing and, maybe more importantly, who's paying for it all.
Yeah, and this analysis really gives you a shortcut to understanding the physical reality of this whole AI boom. We can talk about models and algorithms all day long, but it's the infrastructure, the stuff required to run them, that's really dictating market returns right now. And we're going to start with a very specific recent piece of news that acts as a strong signal.
A signal about sustained demand, right?
Exactly.
And that signal comes from Barclays. It's about a critical infrastructure provider, Vertiv, which trades under the ticker VRT. So Barclays recently moved Vertiv's rating from equal weight up to overweight. And at the same time, they adjusted the price target, raising it from $181 to $200.
And the move itself is notable, but the reason behind it is really the key here. Barclays stated that the recent volatility in the stock price, well, it provided an attractive entry point.
Okay.
And crucially, they believe Vertiv could catch up in valuation against some of the other, already highly valued AI infrastructure names as we look out toward 2026.
I want to pause on that phrase, catch up. What does that imply about where VRT has been and, why is this upgrade so indicative of what's happening right now?
It implies that while the market, understood the need for AI infrastructure, maybe Vertiv's specific role in thermal management was a bit undervalued compared to, say, the chip makers.
The really obvious place.
The obvious place, exactly. This upgrade is basically Barclays confirming that the underlying demand, the need to cool and power these intensely hot facilities, is not only robust, but it's structurally here to stay. We're past the point of hoping to solve cooling with, little fixes. We're in a massive mandated build-out phase that just demands specialized hardware.
Okay, so let's begin there. Let's look at the winners in this spending cycle. We're moving beyond the obvious chip names and looking squarely at these picks and shovels suppliers, the companies providing the foundational elements that make these facilities actually work.
Right. And when analysts look at where capital is flowing first, it's always toward the most immediate physical bottlenecks that AI creates. And that is power, cooling, and specialized thermal management.
So why is the spending so immediate? I mean, for years, data centers ran fine with air cooling. Why this sudden expensive demand for these specialized systems?
It all comes down to density, sheer density. A traditional server rack, non-AI, might draw, 10 to 15 kilowatts of power?
Okay.
An AI training rack, though, packed with GPUs, can draw 50, 80, even over 100 kilowatts in that exact same footprint.
A tenfold increase.
At least. And that concentration of heat just makes air cooling impossible. The components would simply fry. So this forces companies to immediately deploy specialized thermal management, power distribution equipment, and increasingly, liquid cooling.
So we're talking about massive mandatory spending on hardware that just wasn't really a big factor in previous data centers.
Precisely. And that's why you see names like Vertiv Holdings Co., ticker VRT, which specialize in these thermal and power solutions, seeing such tailwinds. We also see Eaton Corp., that's ETN, which provides crucial power management gear to handle those immense power loads.
Right.
Then you've got nVent Electric PL, ticker NVT, and Johnson Controls International, JCI. These are all companies that supply that specialized, often custom-built infrastructure.
So that's our first theme, managing the heat and distributing the power inside the facility. But these places are drawing power like small cities. That means a complete rethink of the overall electrical supply, too.
That's our second theme, backup power and electrical components. The power requirements mean the entire grid supporting them has to be fail-safe and highly scalable. If a facility draws 200 megawatts, any power interruption needs an industrial-scale response.
So we're not talking about the kind of generator you'd buy at a hardware store.
Not at all. Far from it. We're talking industrial machinery, massive equipment to manage utility power coming in, distribute it safely, and then instantly pick up the entire load if the grid fails.
And what does that drive demand for?
Industrial generators, switchgear, which are these complex safety mechanisms that control electrical circuits, and all the heavy-duty components you need for reliable power.
And that brings in a pretty classic group of industrial players.
It does. Caterpillar Inc., ticker CAT, is a beneficiary because of their massive power generation units. Generac Holdings, GNRC, is another key name for backup power systems. And then companies like Hubbell Inc., HUBB, and Emerson Electric, EMR, They supply many of the foundational electrical components that manage the flow of current inside.
The key takeaway here seems to be that you just can't build one of these modern data centers without these parts, and they probably have long lead times.
They do. And that scarcity translates into revenue visibility for these suppliers, which is what the market is rewarding right now.
Okay, let's zoom out from the components and look at the real estate itself. Theme 3 is the data center landlords and colocation operators. I mean, if this demand for power and infrastructure holds up, the companies who own the specialized buildings are long-term winners.
Absolutely. The sustained demand for data center capacity directly supports the operators who lease out space and power. When you hear about capital expenditure CapEx being sustained, it means these facilities are being built and leased as fast as they can be finished.
So for our listeners, could you define colocation? What's the business model here, and why does AI benefit it so much?
Sure. Colocation operators, they lease out dedicated space, can be the cabinets, rooms within their massive, secure facilities. They provide the power, the cooling, security, connectivity, and the customer just brings in their servers.
So they're kind of like specialized real estate companies?
They're essentially specialized REITs. Yeah. Real estate investment trusts. They lease digital capacity instead of apartments. And because AI requires such intense, specialized infrastructure things a company can't easily manage in their own server room, the demand for these professional facilities has just accelerated.
So if the CapEx continues, demand for their product is supported. Which players are positioned here?
The primary names you hear about are Equinix Inc., ticker EQIX, and Digital Realty Trust, which is DLR. They manage huge portfolios of these data centers globally. A slightly different but related player is International Business Machines Corp., IRM, which operates as Iron Mountain and has a growing data center footprint.
Okay, so that gives us a really clear picture of where the capital is flowing, directly into the enabling infrastructure, cooling, power, and land. Now, let's flip this around. This massive spending spree has to be paid for, which leads us to the market segments that are facing pressures from this intense build-out.
That transition is essential. We've established the suppliers are winning. Now we have to ask, who are their customers? And what are those customers giving up to keep spending at this pace?
And the first area of pressure is theme 1, the hyperscalers themselves, the giant cloud providers. They're driving the demand, but they're also bearing the direct financial cost.
Exactly. And let's just define who we mean by hyperscalers. We're talking about Amazon Web Services, Microsoft Azure, and Google Cloud, the largest global cloud platforms.
Right.
They are the ultimate beneficiaries of AI for sure, but they're also the primary buyers of all the VRT, ETN, and DLR capacity we just talked about.
And the speed of this build-out forces them into what analysts call increased capital expenditure intensity.
Which is just a way of saying their building costs are going up. They have to spend a greater portion of their cash flow just to stay competitive in AI. Their power bills are going up dramatically, which can put pressure on their margins.
And there's another factor too, right?
A critical one. The physical availability of reliable electrical power is now becoming a limiting factor for their expansion plans. It's introducing an element of forced scarcity.
So this cost pressure is hitting Amazon, AMZN, Microsoft, MSFT, and Alphabet, which is GOOGO. They have to just keep deploying capital faster and faster.
It's a capital treadmill. They have to spend heavily to get that future revenue growth, but that spending eats into current margins, and it creates execution risk around just getting enough power.
Okay, theme 2 focuses on a market segment that isn't really failing, but it's facing underperformance because the money is just being rotated elsewhere. Legacy enterprise IT spend.
This is a subtle point, but an important one. When a company sets its technology budget, it's often a fixed amount. So as more corporate money gets reallocated to AI infrastructure and cloud capacity, which is seen as necessary for growth, the spending on traditional enterprise refresh products can lag.
Can you clarify what enterprise refresh means here?
Yeah, we're talking about the routine cyclical replacement of existing business tech. New corporate laptops, upgrading established servers that don't run AI, replacing older networking hardware.
The day-to-day stuff.
The day-to-day IT spending. It's stable, but it's discretionary compared to the mandatory need to invest in AI. So when the CFO is looking for money for that multi-million-dollar AI project, the traditional IT budget is often the first place they look.
So we're seeing a deceleration in growth for companies that rely on that regular spending cycle. Who's affected here?
The analysis points to established names like Cisco Systems, CSCO, which relies heavily on enterprise networking hardware. And then you have the traditional computer companies like Hewlett-Packard Enterprise, HPE, and HKE Inc., HPQ. Again, they're not failing, but the relative performance risks being pressured because capital is prioritizing AI over their normal upgrade business.
Okay, let's move to the third major area of pressure, which I think is maybe the least obvious bottleneck until there's a problem: the utilities. Theme 3 is utilities facing the grid upgrade burden.
This is maybe the biggest execution challenge in the entire AI build-out. Utilities in regions with a heavy concentration of data centers are facing some incredibly complicated demands.
Give us a sense of the scale here. What happens when a region suddenly has several new data centers, each one demanding power like a small town?
The existing local power grid was never designed for that.
Mm.
It just wasn't. And the utility is often a regulated monopoly, meaning they have to provide the power, but they can't just absorb the cost of building new substations, massive new transmission lines, all of that. The scale of AI power demand forces these utilities to undertake huge, mandated capital expenditures to upgrade the grid.
And this is where that term rate cases comes in. That sounds like a regulatory headache.
It's entirely regulatory. A utility can't just raise electricity prices to pay for a new power line. They have to go before a state regulatory body and prove the necessity and the cost of the upgrade. That whole process is called a rate case.
And that's to get approval to raise rates on everyone else.
To raise rates on all consumers to recover their investment, what's known as the grid upgrade burden. And that process is time-consuming, it's politically sensitive, and it introduces headline risk about project costs and timelines.
So the demand for AI power is immediate, but the ability to deliver it involves multi-year regulatory hearings and construction. That time mismatch is a huge hurdle.
Precisely. The power company is stuck between immediate demand from their biggest customers, the hyperscalers, and these long regulatory timelines. This affects major utility players in high-growth areas. Companies like Consolidated Edison, ticker ED, PG&E Corp, PCG, and Edison International, which is EIX. The need for these long interconnection timelines is a massive constraint on the entire AI economy.
This has been a complete tour of the flow of capital here. So what does this all mean for the market structure?
Well, the market is showing a powerful, almost one-way flow of capital. It's moving toward the enabling physical infrastructure, the specialized cooling, the high-capacity power systems, the land, and that's creating a long-term growth corridor for those suppliers.
And at the same time,
This spending is creating very clear cost pressures. It's burdening the hyperscalers who have to pay for it all. It's starving traditional IT categories of capital, and it's introducing all this complex regulatory and execution risk for the utilities.
so the winners are selling the tools to manage the constraint, while the losers are either paying to manage it or their business is being overlooked because of the scale of the new spending.
And if we synthesize all of that, the heavy capital spending and power constraints for the hyperscalers and the immense challenges facing the utilities, it leads to a powerful conclusion. We've all heard about chip shortages, but now the ability to secure reliable, long-term sustainable power capacity might be the single most critical limiting factor for AI expansion going forward. Power is the new bottleneck.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.